Welcome, how's it going? What's going on?
Very good, thank you. Very good. Yeah, it's been another sort of good day here at Hay Hill. It's always nice to be here and soak up the atmosphere and bump into a few different people from different backgrounds, family offices, another few hedge funds, and it's amazing how much idea generation happens just from interacting with people.
You can't beat it really, can you? The Zoom thing is just, it's been useful, it's seen us through this year, but I'm just desperate to get back out and see people. Yeah. Even though there might be a 2-metre gap between us at the moment.
Yeah. And it definitely feels a bit clumsy, conversation, talking to people, it definitely feels a bit rusty, but I'm sure a bit of lubrication with some drinks this eevening.
And that makes a huge difference. And that water cooler moment, that chat where you're just shooting the breeze basically. That's where the ideas really come from.
Yeah.
You don't really get that anywhere else. So I can't wait for hopefully this vaccine to kick in. And anyway, we've talked about COVID enough.
Yes.
You've had an interesting year because you came in doing one thing in a very big fund, which you've been integral in building for a number of years, and have come out the other end in quite an exciting new launch. Take me through 2020.
Yeah, it's been an extraordinary year in many ways, and obviously very difficult for some people, which obviously puts a slight downer on things. But for me, on a personal note, it's been fascinating. As you say, started the year with ADG, which itself was an extraordinary story. We started when I joined 5 years ago at 100 million. We grew it to 3.4 billion, and then basically, unfortunately, it sort of shrank quite a bit over the course of the last year with a couple of sort of high-level departures. So I have been sort of thinking about doing my own thing for a number of years. Come from quite an entrepreneurial background, as you know, and managed to persuade the multi-asset team from Hermes to lift out and start our own hedge fund. So it's been a really fun 6 months. We had our first official partners meeting with all of us unencumbered by employment and other disadvantageous things like that.
Yeah.
And that was only basically 2 months ago. We incorporated a month ago, and we got our FCA application in last week. So it's been an incredibly quick process and just great fun. I've got a few bags under the eyes. It's been learning some different areas. I mean, I, as you know, was an experienced asset raiser and had been involved with fund launches, but I hadn't been intimately involved. It was much more strategic, and these are the types of fund we should be looking to launch, and working with partners like launching a UCITS fund with Goldman Sachs, for example. But this is the first time I've had to do the actual heavy lifting myself and look at prospectuses and appoint administrators and finance people and auditors and that side of things. So it's been an extraordinary period. But I'm very grateful to my network, and actually a large part of that network is hedge brunch and AU related, because a lot of those people have I've met socially. You think about the administrators or the IT providers. George Ralph at RFA has become a good friend because of these types of events, for example. And that ecosystem, that sort of naturally organic network of people has just evolved. And
perfect. I mean, that's exactly what we want to create, basically.
Yeah. And what's really interesting about that is when I started this process, I said to my partners, look, I think I can do this, but I'm not. I haven't done it before. And what's been really interesting is actually we've ended up appointing most of the people that we would have appointed anyway through this process. We have taken on an outsourced COO, and basically that's been really helpful in just sort of providing clarity, having someone with the grey hairs that I can pick up the phone to and say, is this the right way to go? And that relationship's worked really well, and has also helped us with the service providers on knowing where the pricing should be, for example. So it's been good.
Yeah, I think a lot of the time with I always say about this network and the network I've been able to build off the back of it is some of the time I'll know the answer, most of the time I don't know the answer, but I know who knows the answer. Yeah. And that's the power of something, a group of people like this. That's the value that we're trying to build and create.
Yeah, and I think it's amazing, even just today, bouncing ideas around with you, with other people here who are working, just the sort of genesis of ideas that comes out of that is really exciting.
So one of the bits I'm most excited about with your fund, and I might note that we've been friends for probably
full disclosure.
10 years.
Full disclosure. We are mates.
We are mates, but we've also kind of grown up, albeit you with a bit more experience than me, in the asset raising space for the hedge fund world, and seen how marketing and sales happens in the hedge fund world, and I've often been very frustrated with the lack of consideration that often CIOs, PMs, leaders, founders of funds pay towards marketing, and the importance of marketing in the process, and the importance of understanding the market you're trying to sell to when building an investment product. Normally, it goes investment product first,
Yep.
marketing second. What I'm really excited about with your fund is that you're the foundation along with the investment team, but there is a marketer who's built into the foundation of it. So to a certain extent, and I'd be interested to see what you think here, to a certain extent, it's a marketing-led strategy in terms of taking it to investors. You have obviously the integral strategy that's being lifted out of the team, but marketing is built into, understanding the market is built into it from day one.
Yeah, look, I think if I look at the successful long-term asset managers in the business, they've had both pieces. You've had the investment side of things, and you've had the asset raising side of things. And there are some companies that we can think of. I mean, when I was first in the industry, there was a company called New Star, and they were the first company that did advertising and billboard advertising things. And they, if anything, had all the emphasis towards marketing. So you can go too far, and they famously blew up shortly after that. And you can have other firms who have phenomenal track records and amazing pedigree in terms of the investment guys, but they don't have the marketing. And I know, and some of them might be watching this, I know some phenomenally talented hedge fund managers who are saying to me, and they're calling me up saying, we've got this 5 sharp strategy, or we've got this terrific strategy, but we're not able to raise assets, and what are we doing wrong? And I have a number of friends, people I've worked with before, who've phenomenal fund managers, but they haven't got the marketing piece.
Alpha's not enough. Alpha is a hygiene factor, and you can't create returns and expect investment. You've got to build a narrative, you've got to build a brand, you have to build a relationship, you have to build understanding. There's so much there.
Yeah, I completely agree with that. I think what's interesting about us, I wouldn't say it's marketing led, I would say it's just an equal...
I'm getting overexcited there.
I know. Well, we're former marketers, so we like to talk our own book. But yeah, it's natural. But what's exciting is you have 2 fund managers who've worked together for 15 years and have a phenomenal track record, and then you have 2 marketers, myself and Anna, who both have raised several billion between us. So between the 4 of us, we have raised or managed over $10 billion during our careers. So I think we're in pretty good stead.
Fantastic. So I'm going to pick it apart a bit if I can. Not in depth, we're not going to go boring, but we just want the headline stuff.
How technical.
Talk me through the name to start with.
Shikuma. Yeah.
Where's that come from?
So what was really interesting when we started putting together the naming conventions, right? First of all, there are basically 2 ways you can name a hedge fund, right? It's a colour and an inanimate object, right? The blue bays, or we all know all the various different permutations of those. Or you name it after the street you're on, and maybe you name it after your initials, right? So we kind of wanted to get away from
You've got the Latin and castle combination as well. Yeah.
True. So we just wanted to sort of start from a blank sheet of paper.
Yeah. Totally.
And when we started doing that, we kept coming back to the image of the bear. And so, the bear for us is an animal which is omnivorous. It can hunt. It can get through all conditions. It's nimble. It can climb. It can hibernate. When you need to. And sometimes in markets you need to hibernate, right?
Okay. Yeah.
But you call something a bear in markets, and people are going to think it's a bear market fund, right? So then we started looking at the various derivatives, and let's face it, Latin is a bit poncy. Italian. 2 of us are Italian, so we didn't necessarily want to go down that route. And actually, all of us, for various reasons, personal reasons, have this sort of affinity to Japan in various ways. So, kuma in Japanese means bear, and in Old Japanese, I understand shikuma is another variation for sort of brown bear. And one of the fund managers comes from the Tyrol Mountains, so bears are a native. Yeah. Another one's from Canada. So obviously bears being featuring. So it was basically a very long-winded way of saying that bears for us have a significance, and we just quite like that.
Fantastic. And that, from what I understand so far, that nature and everything that the name represents is reflected somewhat in the strategy.
You've just teed me up perfectly. It's almost like you've done this before. So Yeah, the idea of the strategy is to be nimble, it's to be flexible, it's to be able to capture alpha in all market conditions. So like the bear, the idea is we can go anywhere, we can invest across asset classes, we can be fast and be slow. So the strategy is both systematic and discretionary. There are two components to it, ultimately discretionary macro, but there is a large systematic element to it. And again, this is the sort of dichotomy within both the strategy and the nature of the bear, which is that we want to be able to be fierce when we want to be, and we want to be also be more safety and protective when we want to be. Yeah. So that's the nature of the strategy.
That's really interesting. I think this is coming through a lot recently. Maybe it's a bias of mine or a bias of the members we have, but that dichotomy of the hedge fund that existed, say, pre-2000 in the 90s, that kind of punchy returns, private capital, family office capital, risk-loving, volatility-loving, punchy, double-digit returns. That evolved in the 2000s into institutional-ready hedge funds.
Yeah.
High single digits, nice, reliable, 7%, 8%, low vol, and that's where the massive assets were gathered, and we had a whole new industry all of a sudden.
And it's an asset gathering exercise. And I think that is correct. What we've done is compartmentalized ourselves as an industry. So now you have strategies which are incredibly pigeonholed, and we've done it to ourselves. And now what we're effectively offering is individual risk premia for a large sophisticated allocator to then say, okay, I want a short-term trend follower and a systematic macro analyst and a discretionary macro guy, and a vol trader, right? And what we're saying is, whoa, there, whilst that is conceptually a really interesting concept, none of those are going to be able to perform through a cycle. They're all going to have their periods, and we've seen it with CTA. I spent a lot of my career with CTAs, did very well post 2008 and through the financial crisis, and then have basically struggled in the intervening years. And yes, I think there's definitely a place for trend following in a portfolio, but that's probably now a 0.3, 0.4 sharp type strategy. So I don't think, personally, and sorry for all my friends who are in that space, I don't necessarily think that's something that should be sold as a standalone product anymore. So what we've done is we've taken trend, but then we've mated it to some inflation type models. Then we've put some more sort of GTAA, tactical asset allocation type models, and then we put together all of that. So that's our sort of quant piece. Right, and that ticks along in the background. That gives you your, let's say, one sharp when you put the three models together. And then what we have is the discretionary piece. And the idea of the discretionary piece is to add convexity to that. So, I've worked with some super smart fund managers from Fulcrum, Harmonic, ADG, but all of those strategies were fallible in their own way. And ultimately, for me, even though I spent my whole career in quant, I've come to the realization that quant is great, and you can grind out maybe a one sharp strategy in quant, but it's never going to know about a pandemic. It's not going to know about what Trump has tweeted at 4 a.m. It's not going to know about the results of the election necessarily. I mean, yes, you can code these things, and there are people out there doing very clever things in that space. But ultimately, our decision was this should be a discretionary program. And when we look at the return streams and we break out the discretionary piece versus the quant piece, they complement each other really well. So if I think back to the COVID crisis, the quant piece didn't do very well. The models don't know there's a pandemic, right? There's no pandemic factor built into any.
Can't model the plague, the markets and the plague.
No, exactly.
Not that much really. Anyway.
But actually, we made money through the pandemic initial 2 months, March, April, because the discretionary side of things was suddenly, the traders there waking up every morning going, right, all this opportunity, all this alpha to capture. So that. And that then allows us to stay in our long-term positions that the quant model gives us, because actually if you're making premium and you're adding convexity through options, then suddenly it means you can stay in your long-term positions and actually even add more risks to them. So suddenly it's a really nice way of ratcheting up the returns.
And what's as it stands at the moment in the kind of early days, do you have a certain type of investor in mind for this fund, or are you still going? You've got a incredibly wide-ranging list of relationships with institutional investors and family offices alike. it feels like this is a bit more built for the slightly more dynamic risk-loving family offices, but there's maybe some stuff that the slightly more risky end of the institutional side would come into as well.
So the way I think about this is if you, as an allocator, have invested time in building out a number of researchers in your team, so naturally the bigger firms, and you have multiple analysts who look at each of the individual building blocks, then this probably won't be for you because you'll want to put it together yourself. So it will naturally be the smaller and more risk-tolerant investors who like this program, because we are targeting, let's call it 18 vol before fees. So it's definitely at the higher end of the spectrum. That's definitely a component, the vol that we're taking. But I think what's interesting is, if I'm an allocator today, and I wake up in the morning and I look across asset classes, I go, well, equities look toppy. I'm not sure I'd want to be adding equity risk at the moment. I look at fixed income and say, well, these markets are completely distorted by central banks, so I'm not particularly comfortable having, I think I read this week, and someone probably called me out on this in the notes, but I think it's 10 trillion in negative yielding bonds now. Right, so I'm looking at thinking, I don't necessarily want to be in bonds. What asset classes are left? Where else can I put risk? And that's where I think somebody who can navigate those markets, who can take directional exposure to equities and bonds, and also then give you diversifying exposure to gold, other commodities, to crypto potentially. It's not a big part of what we do, but we have made money in crypto in short-term trading on the discretionary side of things. Somebody who can take your asset allocation exposure, but then add alpha through convexity, through optionality, through short-term trading, and also, frankly, through having some discretionary calls, some long-term discretionary calls. So I think it's naturally suited to the smaller investors with a high risk tolerance. Is the short answer.
Well, you touched on it a bit there. Is this a instrument agnostic approach? Is it? How wide is the spectrum that you're looking at when it comes to what you're trading?
So the core portfolio, so all things being equal, markets, nothing sort of exogenous happening in markets, let's put it that way, then the quant piece will trade, let's call it 15 to 20 instruments, and it's your main equity indices, your main G5 bonds, and 3 commodities basically. So it's a fairly sort of pared back core portfolio. Mm-hmm. And then really it's with the discretionary piece where we can start saying, actually, 2 years ago we think there's an opportunity in Turkish lira, or this year looking at the ruble carry trade, or looking at Bitcoin more recently, or trading around the election, some potentially single stocks, things like that. So it's the nice thing about it is it's very liquid, and it means that we can have your sort of core portfolio that grinds out, let's call it the 1 sharp, and then the systematic piece, and then the discretionary piece rather gives you your additional alpha, takes it up to 1.5 to 2 sharp type strategy.
And is there, well, you can probably split this into the 2 sides of the fund, but is there going to be any limit to what you're going to be trading? In terms of assets?
In terms of assets, there isn't the instruments that we trade are very liquid, but the intention here is not to build, another AQR or bridge, whatever.
You don't want to gather and gather and gather.
We don't want to gather and gather, and it's all power to those people, right? For us, we're managing our own money this way. We would be doing that anyway, but what we've said is, look, if we're going to create these structures, and if there is a cost associated with them, and we want to do this for ourselves, why not invite, people who we've known in the industry for a long period of time to come in alongside us, and say to them, we're doing this. We are going to be very heavily aligned with you in that we're running the vast majority of our own money in these strategies. Come in with us, share the cost, share the ride, share the experience. I'm not sure if I'm allowed to say this for camera. Maybe you have to edit this out. But we're annualizing at very high double-digit numbers for the 2.5 years we've been running the program. So
we'll put a disclaimer in that.
Yeah,
that's absolutely fine.
Yeah,
we're compliant, but we're friendly. That's what we want to be. So.
Exactly. So, the numbers look good, and I think what we'd like to do, if I think about this business in, let's call it 5 years' time, 5 to 10 years' time, I'd like to be able to say that I have 20 to 30 investors who we've known for a long time, who have been with us from quite early on, and we want to then, be at a point ideally in a few years' time where we're basically saying to them, look, actually, we can even reduce fees because we're now at a scale that we can do that. So,
well, that's my next question. How can we talk about fees?
We can talk about
What are
fees.
you feeling about our traditional turn 20? Is that still alive and well?
Oh, I mean, there are people who charge 220. I've charged 220, and I've had investors that are happy paying 220. So this idea that it's going away is something that writes headlines and creates news stories. The best hedge funds can command 3 and 30, or
even more.
For us, as I say, because we were doing this ourselves, because we're running our own money this way, we're not looking to basically just be an asset gathering machine and just to raise most of the money off the fees. What we want to do is make the money from the performance of the strategy. If we can compound our own money at, let's call it 20%, then that's how we want to get wealthy, not from raking in fees from our clients necessarily. So that's the ethos behind it. So we're going to start, let's just say, significantly below 2 and 20, and the intention is that we probably will never get to 2 and 20. If anything, we're more likely to, as I say, reduce the management fee as we grow. I'd like to weight things much more towards performance.
So one of the major themes this year, I think Davos this year really kicked it off before we all went to COVID, was the ESG, everything. What's your feeling on that in your strategy and in general? Is it is it going to be greenwashing, or are we actually going to be doing any good?
I think that's a really interesting question in terms of the greenwashing piece. I think for us, we're mostly trading futures, and so ESG is less obvious in terms of having a proactive and positive impact on, say, the companies that we're investing in, whether that's negative or positive socially responsible investment. And I think these matters are important, right? I think we need to all state that. I think we all know that these are important things. For me, I'm concerned. I mean, you use the term greenwashing. I'm concerned that people will sort of formulate a policy and they won't really give a great deal of thought actually about their personal sort of commitment to things. So where I come from, this is slightly different. I'm of the view that our investors are investing us to gain a return on their capital. And I think that our investors, it's really incumbent on them to implement the capital that we're generating for them in a socially responsible way. So I slightly push back on the investors, and that, I think, is how it should be. I don't think we should be prescriptive about how this money should be spent. Now, that said, I'm very proud on a personal note to this. My previous firm, ADG, ran a wonderful charity, for example. They don't tell many people about it, but we did a huge amount of positive work for that charity, and that was something I'm very proud to have been involved in. I was in a meeting with Tommaso, my CIA, the fund manager, and we've been in this all-day meeting. He said, "Tom, it's nearly 4 o'clock. I'm going to have to go." And I said, "We're in the middle of a quite important day of talking about things." He said, "What is so important?" He said, "I have to go and look after my elderly neighbour." This is a guy who Friday afternoon is saying, "I have to go and look after my elderly neighbour. His wife just passed away, and I want to go and take care of him." I go and talk to him about things. I help him around the house. Now, to me, that says a lot more about a person than a boilerplate ESG policy at the back of a presentation.
Yeah, that makes sense to me. I mean, I think there are ESG-focused funds who are doing a fantastic job of really focusing on it and sticking their hand up and saying, "This is what we do."
Yeah.
But just putting a blanket application of "we are ESG" on your pitch deck when you may well not be. I'm sure some people will use it how it shouldn't be used. That's going backwards rather than going forwards.
Yeah.
So no, I can see where you are, and I think as long as you're setting out your stall early on and saying, this is what we are and this is what we aren't, then that's the key. Really. A lot of the ethos and a lot of the focus with AYU is trust and transparency and relationships and the stories that we're telling between members and sharing between members. So having that up front is absolutely key.
Yeah.
So yeah, really good to hear that.
Yeah.
So we're coming to the end of 2020. We're coming, hopefully, eking our way out of COVID, Corona, lockdown. What do you see for 2021 for the fund, for the world, for you and Marina?
So much opportunity at the moment is the first thing to say. I mean, we're literally rubbing our hands together. I can't think of a more exciting time to be launching a discretionary macro strategy than at present. We're seeing a return to dispersion, a return to volatility, some really interesting things happening in the bond market, in currencies, which is where we think a lot of the excitement will be over the coming period, because central banks have impacted on both equity and bond markets so much. We think currencies are going to be where a large part of the interesting developments are over the coming year. On a personal note, the business launches or the fund hopefully will launch around May, June next year. So that for me is my absolute sort of focus. And on a personal note, I look forward to more of these types of events. So seeing real people in person, networking, bouncing ideas around, having a drink. It's allowed. I think that sort of thing is important. So,
and what are you going to be doing? It's an interesting question when it comes to what world we're going to be living in a post-COVID space. Are you guys, as a new fund, going to be taking office space? Are you going to be working from different countries? How are you going to be moving into this new hybrid world?
Yeah. So the way we've approached everything is set it up on the basis that we'll never be allowed into an office again. And then that way, if we are able to in the future, then we will. But I think the nature of, interesting talking to a few people, just this morning, people talking about working from Mexico and Croatia, and I think that's the way things are moving. And also, I think also that the sheer number of jobs a lot of people now have. So people are doing lots of different things. This idea of a portfolio career and being digital nomads. You can be working from pretty much anywhere. So we will be based in London, but we're fairly international. As you know, my wife's Spanish. Two of the PMs are from Italy. Another Anna is from Canada. So we all have family. I think we'd like to build it in such a way that we can be based in different places, but being able to come together in London for client meetings or idea generation and sort of regular meets, and
maybe Cape Town, Johannesburg, summer 2021.
That could be
maybe
interesting.
Some reason.
Is there any
to
sporting events happening at that time of year?
Yeah, we've got a team together.
Could be interesting.
Tom, wonderful to see you. Thank you so much.
Thank you.
Don't shake my hand.
I failed the test.
We can't do that. We can't do COVID. Okay, we can do this. Thanks very much, man.